the defined benefit plan, defined benefit plan, the employer will need to make some assumptions, or we need to make some estimate about the future, which will enable the employer to be able to determine the benefit payable to the employees on what? On retirement. Remember, here we have said that the benefit payable to the employees under this type of post-employment benefit plan, they are defined. They are known in what? In advance. And therefore, for the employer to be able to determine those benefits and also to determine the contribution he need to be making, maybe monthly or annually, he need to make those what? Assumptions. And therefore, these are the estimate which will be made about the future and which enable the employer to be able to determine benefit and contribution to be made maybe annually or monthly. Now, these particular actuarial assumptions are usually classified into two. One, we do have what we refer as the financial assumptions, of which we'll talk about now. These assumptions, they include assumptions concerning the expected salary increment, things like the discount rate, things like the expected market interest rate, market interest rate, and so on. Now, on the other hand, we do have what we refer as a demographic assumptions, and these are assumptions concerning maybe early retirement of the employees, the mortality rate, what we refer as employees turnover, or maybe the employees who are expected to leave the company, and so on. Now, these particular assumptions, generally what we have said is that they are made by the employer for him to be able to determine the benefit payable to the employees and also the contribution which he will be making. But what we have said is that once we have these assumptions which are made by the employer, then there may be a difference. There may be a difference between those assumptions, that is between actuarial assumptions, and what actually happens, and what actually happens. And if that is the case, then the employer may be required to make more contribution or less contribution than he had determined using the actuarial assumptions which he had made. And therefore, once now the employer is required to make more contribution or less contribution, then that will give rise to something we refer to as actuarial gain or actuarial loss, meaning that the actuarial gain or actuarial loss will arise. The actuarial gain or actuarial loss arises simply because the employer will be required to make more contribution or less contribution than what he had actually determined. And therefore, that is how we compute this particular actuarial gain or loss. So mean that we need to look on how we compute the actuarial gain, computation of actuarial gain stroke loss, of which now whenever this actuarial gain or loss is to be computed, should be computed both in respect now to the plan asset and also in respect to the present value of the defined benefit obligation. Remember, what we have said is that if we have an employer, maybe a company, this employer or this company may be operating what we refer as a retirement benefit scheme. Now, once now the employer here, or maybe this company, make contributions, then those contributions will be forwarded to this retirement benefit scheme. And what you need to note is that we may be having a retirement benefit scheme which is under the control of the employer, but on the other hand, we do have those retirement benefit schemes which are not under the control of the employer. So in this case, you're talking of a retirement benefit scheme which is under the control of the employer. Now, once now the contributions are forwarded to this retirement benefit scheme, we have said that this retirement benefit scheme, first of all, it will invest those contributions, and as a result of that, it will be having some assets which are known as planhood asset. On the other hand, this retirement benefit plan here will be having an obligation to pay the benefits to the employees once they proceed for their retirement. And basically, what you have said is that in case of a defined benefit plan, the benefits which are payable to the employees on their retirement are known with, or they are determined in advance. And therefore, what you have said is that whenever now the employer will be accounting for them, he need to get their present value, of which in that case now we have referred to the present value of those benefits payable in future as the present value of the defined benefit obligation. And therefore, when computing this actuarial gain or loss, we compute it in respect to plan asset and also in respect to what? Defined benefit obligation. Now, first of all, to compute now the actuarial gain, stroke loss on first of all plan asset, or basically we refer to that as fair value of plan asset. What we do is that we are supposed to take the fair value of a plan asset, as at the start of the year, Now this, we are going to adjust it with a number of items. One, we or to that we add the expected return on plan asset. When talk about the expected return on plan asset, these are the returns, e.g. dividends, e.g. interest expected to be generated by the plan asset. So once now a retirement benefit scheme receives any form of income from a planned asset, that by the end of the day increases the value of the planned asset. To that still we add the contributions to the scheme, Now in this case, when talk about the contributions to the scheme, these are the contributions made by the employer to this retirement benefit scheme. Once now we have such contributions, by the end of the day they keep on increasing the value of the planned asset. And then from there we deduct the benefits paid. When talk about the benefits which are paid, we are talking of maybe the pension which has been paid to the employees who have already proceeded for their retirement. Once now we have benefits which are paid, they are paid from this plan asset. Once we have a payment from the plan asset, the value of the plan asset reduces, and that's why we are deducting that from the fair value of the plan asset. And then what we are supposed to do is to compute now the fair value of the plan asset based on some of the previous actuarial assumptions which were made. And once now we compute that fair value of plan asset as at the end of the year, then this particular company here will engage a person who is known as an actuary, to come in and do the valuation of this particular plan asset as at the end of the year. And therefore, once now that fair value of the plan asset is determined at the end of the year, we will be having it here, the fair value of plan assets as per the valuation which was done at the end of the then what we need to do is basically to compare these two values, the fair value of the plan asset as at the end of the year and the fair value of the plan asset based on some of the previous actuarial assumptions. So the difference between the two here will be an actuarial gain, stroke loss, of which in this case, because this is an asset, if at all we have increase in the value, that is an actuarial gain. If we have a decrease in the value, that is always an actuarial loss, meaning that if at all maybe as per the valuation which is done at the end of the year, there is an increase in the value of the plan asset, that will be an actuarial loss. If there is a decrease, then there is an actuarial a loss. So that's ordinarily how we compute the actuarial gain or loss as far as the plan assets are concerned. Then let's look on how we compute the actuarial gain. Stroke loss on present value of defined benefit obligation. Remember, we have said that a defined benefit obligation, that is the present value of defined benefit obligation. This is the present value of the benefit payable to the employees in future. So therefore, to an entity which operates this retirement benefit scheme, this is a form of a non-current liability, is a form of a non-current liability, is a form of a long-term liability. And therefore, in terms of how we compute the actuarial gain or loss in respect to this, we will be given we take the present value of the defined benefit obligation as at the start of the year, and then to this we are supposed to add a number of items here, of which in our previous class we defined some of these terms. One, we add the interest cost. Interest cost, we said it is the increase in the present value of the defined benefit obligation because the employees benefit are one period closer to a settlement. That definitely is supposed to increase that. Two, we add the current service cost. We add it there. We also add the past service cost. All those three items are supposed now to increase the present value of the defined benefit obligation. Now, once now we add those three items, then we should proceed and we deduct. Benefit paid. The reason why we deduct this benefit paid is because once we have some benefits which are paid by a retirement benefit scheme, then the obligation to pay benefit in future keep on reducing. So that's why we are supposed to deduct that there. So once now we deduct that, we are then supposed to compare whatever we are going to get there with the present value, of the defined benefit obligation as at the end of the year. Still, this present value of defined benefit obligation is the present value of benefit payable in future as determined by this a professional who is known as what? As an actuary. And if at all maybe there is any difference between these two values, that will be an actuarial gain or loss, meaning that the difference here is an actuarial gain stroke loss. And what you need to note here is that this present value of a defined benefit obligation, basically if said to an employer, is a non-current liability, meaning that if at all maybe there is as per the valuation which is done at the end of the year, there is an increase. There is what? An increase in the present value of defined benefit obligation. Any increase is automatically a loss. Is automatically what? A loss, because if at all the valuation, or there is a valuation which is done, and as a result of that the value of a liability increases, then to the employer, that is what? That is a loss. So therefore any increase is a loss, meaning that any decrease here, that is what? That is a gain. That is what? A gain. So therefore a decrease in respect to that is what? Is a gain. So generally that's how we compute what if far as actuarial gain or loss as far as the present value of the defined benefit obligation is actually concerned.